Well, welcome everyone to Payments on Tap, your executive happy hour for payments leadership, serving insights and crafting the future of payments together. So each episode, we break down the trends, challenges, and opportunities shaping payments and financial services so you, listeners, can turn complexity into clarity and strategy into action. So I'm your host, Elyssa Morgan at NEACH, and today we're opening our first episode with a conversation that blends what we learned from our 2025 FinTech collaboration survey with real-world lessons from a former bank CEO who spearheaded FinTech integration and services, Kevin Johnston at Braid. So if you ever thought FinTech partnerships sounded exciting but overwhelming, this episode is for you. So the conversation is especially ideal for community banks, credit unions, and regional financial institutions that know FinTech partnerships are critical to growth, but don't yet have a repeatable, defensible way to execute them. So, Kevin, welcome to Payments on Tap. Before we dive in, why don't you tell our listeners a little bit about yourself, your career journey, what drew you to FinTech, and what you're focused on now at Braid?
Thank you. Well, contrary to description, I was not CEO. I was COO. I've never been that big of a deal. So yes, I think what's interesting about, where I am now is really it started at a bank. When I left law school, I went to Gonzaga Law. I didn't know what I was going to do. And I did a little bit of real estate and estate planning in a small town in Washington. And then I moved to Seattle area and started in banking, not knowing anything, never having taken any finance class, anything like this, knowing less than anybody really could, a teller or, an introductory teller job, from the very beginning. But then, I was doing commercial lending and it got more and more complex over time. And eventually, after having left 3 institutions and having built portfolios there, we decided, 4 individuals and I, to buy an institution out of Minnesota and really bridge a gap that we saw in the marketplace with respect to the existing lending landscape. The issue was that there are not enough banks in the Seattle area to service all of the stable of clients that we had built. And so there's a significant amount of overflow. And we thought, you know what, let's buy a charter of our own and build it and kind of offer another opportunity. I think at the time there were probably 32 charters in Washington, maybe 34, but we thought, hey, maybe we can add another one. So we did. That little bank, which was called State Bank of Ceylon in a town of 300 people, was very small, $11 million in their total kind of asset size and $3 million in loans, and really just treading water. Maybe even treading water as it circled the drain. And, there's a little bit of a potential conspiracy about that. Hey, did they give us this charter just because this thing was gonna go downhill? And it did go downhill. It continued to go downhill for about 9 months until we grew out of all the tech we needed to invest in. We needed to redo all of the documentation, for example, for lending. We needed to redo all of the back-end systems and make sure that the core could support what we wanted to do. This institution was a problem for the local area because with the growth in regulation, it had not been able to keep up. And so they could not disclose APRs correctly. And that meant a lot of consumer loans were actually completely off limits to this little charter when we bought it. And so it required, rebuilding the whole thing. We're no longer going to be doing our loans on a typewriter, our loan documents. And so we did buy the institution and, many embarrassing stories about how little I knew about, when the regulators came to town the first time, which was only a couple months after we bought it. And, but really kind of getting our feet under us quickly and growing it to a very, high performing, given its size, which was very small, high performing little institution. And we also moved it to Seattle area formally a couple of years later, third, fourth state to state charter transition in US history. And all the other ones are like these guys you've heard of, we're just nobodies. And these guys are all, Capital One and these types of things. So the whole point of buying this charter was actually not just to service the local loan market in Seattle. It was also to do something more interesting, and that was to do payments. The group that bought it was a loan, very typical vanilla type bank operators and kind of attendant features to that, whether it's mortgage or there's a builder who was involved as well. And so we decided that once we were stable, we wanted to do something else. And we did. And again, we knew nothing, or less than nothing, actually. You can know nothing and that's fine, but knowing less than nothing is like where you're actually doing dangerous things, and so we were doing dangerous things, unfortunately. And so our first partner, we hosted wallets for a payments program. We grew to about 15,000 wallets, and not for a payments program, for a social media company. And again, didn't know what we were doing. We would hand the file to the regulators every time they came to town, but I don't think they really understood what we were doing. And ultimately, it just ended up breezed over 2 exams in a row, 2 exam cycles. And then before the third exam cycle, we started to realize how little we knew. It's one of those kind of come to moments where you look back and think, hey, maybe we need to operate a little more carefully here.
It's an important moment, recognizing what you don't know.
Yes. Oh my goodness. Yeah. Yeah. I mean, we knew it all along in some ways, but in others, when you kind of wake up to it, you get a little bit, scared for your past, and then, okay, well, now what do we have to do? And so what we ended up doing with these guys was we were visiting them, and they put us in a room full of potential FinTech partners that would enhance the relationship between all of us. And at this point, we were pretty frustrated with how that relationship was going. And there was one group in the room that turns out to be the eventual founders of Braid. And at that time, they were called RopeChain and RopeChain.io. And RopeChain was meant to kind of bridge the gap between the old and new way of kind of the financial worlds that I think is still coming down the road. But we all thought that was a little too aggressive. And so they changed their name to Braid eventually, to kind of try to figure out where the traditional finance guys were. So that is where this all started, was at this little bank that became Portage Bank in Seattle. Now, I think when we started with Braid, we were around 40 million in total assets at that point. And now I believe they're about 100 or 120 million. So still a very small institution, all things considered. But, of course, well, the first thing that you realize when you start to realize what you don't know with a payments partner is BSA.
Yeah.
Okay, where's the money? Where is this money going? And what are our controls on this relationship? How good is our contract? Things like this.
Yep.
And so that was kind of where it became serious very quickly. And how that came about was actually something that became focal and innate to what Braid is. And so specifically, what we would see when we were watching the program and the operational, balances, we would see KYC that was inconsistent with respect to the amounts that were being transferred between these wallets on this social media company. And it turns out that they could change the rules without us knowing anything about, when KYC would or would not be, that was fully embedded and a good, well done, but when it would be required. It could be for $200, it could be for $60, it could be for $1,200, and it kept moving. And we did not realize that, even though we were having consistent meetings with these individuals it took us a long time to figure that out, okay, wait a second, why is this file not there? And why is that file there? You can only see, of course, in a dashboard what you can, you can only discover what you can see. So Braid handles all of that now, and that was kind of why it made a lot of sense after we had engaged Braid to build this program with us. And we can talk about what Braid is in a moment, but basically that level of control is something that we felt the institution needed. And part of the journey was us going to these larger institutions that had been doing this for a long time. Guys that we really respect in the industry. I think the world of Coastal Community Bank, I mean, they are kind of they're our, idol. We want to grow up and be those guys, when we were doing what we were doing at Portage. And and thinking the world of exactly kind of how this was going for these other institutions, but also not knowing how to execute. There were other institutions that were pretty nascent that we would talk to, and they were smaller, and they would say, the CEOs would get on a call with us, and always really, kind and sharing about what the program should look like. But they would always say, you should see our legal agreements. You should see our legal agreements. They're so good. Our lawyers have covered every avenue, every angle here is perfect. And I would always leave those conversations just thinking, man, if you have to call your lawyer, it's already too late. If you're going to legal to enforce a contract, some failure in the control mechanism is already missing and has not gone right. And the fact that the CEOs and the C-suites that we had spoken to were always thinking about legal first. Oh, make sure your legal has this and that. Meant to us that there was something missing from the software piece that needed to be in place. The bank needed control over the software. They needed to be able to set the rules so that that partner that we used to have could never change the amount that could be transferred between wallets without us either knowing or a reject just simply, not authorizing the transfer without this KYC being triggered. So that's kind of, where we started and how we got hints that, hey, something needs to be built a little differently here. How's that? What do you think?
No, that was great. I think that recognizing or building based on experience, a lot of times folks are building, say, for banks or for financial institutions, and they've never been a bank or a financial institution, piloting programs and things like that. So I think that's great that that's where this came from. And it sounds like we've got the right person to help us kind of unpack everything we're going to talk about today. Thanks for the introduction and telling us a little bit about yourself. So just to set the stakes and get into the data a little bit. So last year, NEACH actually launched its FinTech collaboration survey to financial institutions nationwide. Then we kind of segmented out some regions. And here's what the data told us across the board. 72% of respondents said they think FinTech partnerships are critical to growth, but only 28% of those folks felt prepared to execute. 61% flagged risk and governance as their top barrier. And here, a lot of times where legal comes in, right? Like you were talking about. And then nearly 50% of those folks admitted they don't have a clear framework in place or don't know what it takes to even start. Where do they start and how do they build one? So it told us, the appetite is high. There's a need, but the playbook is what's missing, right? So when we talk about successful FinTech integration, we're not just talking about getting to go live. We're talking about partnerships that can scale safely, generate durable revenue. We just listened to the growth of the asset side of the financial institution you were talking about. And really also these programs ensuring that they can stand up to regulatory scrutiny over time. So that became kind of our first deliverable, this playbook. So together with you at Braid, we are launching this executive series that leaders can actually act on, right? So they have strategic planning, roles and responsibilities outlined, payment rails, underwriting, ongoing due diligence, and then the legal architecture, as you were mentioning. So each module in this series delivers tangible outputs. And I have a few questions once we get into it related to each focus area, a few questions for you. So first, I guess, Kevin, from your perspective, why does having a life cycle program from evaluation through scaling change the outcome for smaller institutions like your previous one?
Yeah. So what we felt at Portage and really kind of how it became at Braid was that we couldn't do this with a BaaS type deployment. We felt like there was a transparency issue there, and you have a perverse incentive between a FinTech and a BaaS layer because they're able to raise billions of dollars. They've got the fancy tech. They've got kind of the sexy outlook on everything. They've got the, cost of acquisition that they kind of think about per customer. They have a little bit of a different metric, but really they're reselling the bank's products. Yeah. And more importantly than that, the bank is the one holding the bag when the examiners come to town. And so while this perverse incentive, this perverse financial incentive with these people that are kind of able to raise a lot of money and kind of do things that banks are not, we thought that the bank really needs to be in control if it's going to shoulder all the risk. And so that's exactly kind of how we positioned Braid. And it's also how we positioned building the program, that we needed to start at the very beginning, start informing the board of what we were doing. And then, as I've said it many times, as I've said many times, that we thought you need to build it out of your own flesh and blood. You needed to carve this out of yourself, out of the bank, and make it a part of what the institution, a whole new business line that the institution stands for. The important thing that we learned really quickly, and kind of as I would read, like I read every ACH manual and I would get everything I could get my hands on, because we started,
stuff.
Yes, totally. We started with ACH. I mean, I was asking the dumbest questions to people to try to figure out how does this work, and luckily, I have no shame in asking dumb questions. So I was able to kind of get over that quick, and we could kind of get to where we needed to go. But the fact is that, learning all of this stuff, you realize that you actually see it every day already in the institution. You're seeing it on the ACH rails, that you're running for, your bill pay or your whatever the background processes are for how you're operating your institution. These are things that you're already doing. You're already doing BSA. You're already doing vendor management, and third-party risk management. You're already doing all of these things. And so what it becomes is an intensification exercise where you say, okay, how can I know more about what I'm doing to the degree that it's offsetting the risks that are presented by intensifying and then increasing scale? And so that's kind of how I looked at it at the time of like, how do we, when you ask, okay, well, why is it important to do it the way that we see as really the right way to do it? That is the answer is the bank needs to be in control, because the bank is the one who can get fined if they missed an OFAC. They can get, they can have all sorts of penalties and regulatory issues with respect to BSA, compliance on Reg E, you can have fines, you can have problems, you can have, all sorts of issues that need to be thought about prior. And that's exactly what we think why this course came into kind of what Braid wanted to do and add to the ecosystem. To kind of contextualize real quick. So I did leave the bank last December, about a year ago now. And then I worked in M&A for a friend for a while doing legal work. And then now I am getting back into, since October, I've been working with Braid. And I was brought on to educate institutions about how do you build this internally, and how do you make sure that you're operating correctly and that your posture and stature with respect to the regulators and the payments companies, the FinTechs, directly integrating to the institution. How can that happen effectively? And so this course is kind of the whole point of, okay, let's create it would feel like a beginner's course to somebody who's touched this stuff a lot. But to everyone else, it's going to feel like when you're starting to do it, it's going to feel very challenging and difficult. And I will say that once you are done with it, you'll look back and think, okay, I already knew all that. In some way, I already knew about this rail, this ACH or YR rail. I already knew about BSA and all of these different things. It's just this intensification and really kind of making sure that you're thinking carefully about what you're doing going forward.
So then let's get real here, because we have a lot of folks being like, the risk is just too high, right? So and we've seen folks under consent orders and things like that because they're not managing the risk relative to their relationships, right? So where do you think FI FinTech programs stumble the most in this area? Do you think it's the roles? Do you think it's the rails they're using and the expertise? Is it the risk?
Yeah.
What do you think?
Yeah, I unfortunately, you end up using the same lines a lot when you talk about this stuff a lot, because I do like it. I really like payments. I really like kind of what I do. And I like this area of banking. You don't need to be a genius to do this. And that's, I think, what a lot of people think. They think, oh, well, the FinTech knows all this stuff that we don't know. And the FinTech thinks the same exact thing about the bank, by the way. They think that everybody thinks they're a wizard in this whole thing. And everybody thinks that, oh, hey, I'll never figure out how they're doing X, Y, and Z. When we designed this course, we actually called it paper walls, because what we see is, it's kind of our slang term for what we wanted to build. What we see is a lot of pretend and a lot of like, hey, if you knew what was right next to you behind this paper wall, you would tear it out and you would just do it, because it's way easier for you. And that's why if the bank is in control, the fintech is direct to the bank, you don't have an intermediary instrumental layer other than the software that Braid is, in this model that we're talking about. You end up essentially holding all of the power, and then really being able to extend your institutional reach in a way that little banks have never been able to do effectively. And so that's the point. But as far as kind of, the risk and reward and all these questions, you don't need to be a genius, but you do need to do your due diligence. And that's where we see, I think, these problems happen. Is you can hear about, consent orders where they've got 75,000 OFAC hits, whether positive or negative, that have never been cleared, and you can hear about BSA backlogs that are just never really reviewed, or someone leaves and they don't replace them at the institution, like the BSA officer or the compliance officer. Or, what we see a lot is actually management needs to have skin in the game. They need to understand what they're doing, and the board needs to demand from internal management, and then just from the operational side, transparency all the way through the institution. It doesn't mean that everybody at the bank, most banks do not have, an expert in loans, an expert in deposits, so it's not as though you need like somebody who really knows everything in the world about payments on your board to do this, because we're kind of talking about the payment side. It's really that what you need is people that are paying attention, willing to learn a little bit, and really that kind of are okay saying, hey, I'm the local accountant in the town that our bank is in, but I, get to learn about this function of the institution. And yes, it is going to be a little more demanding than it might be on another director. But the point is that this is creating an excellence in the institution, and the reward really can be very great for the institution if it's done correctly.
Yeah, and we'll get into the reward, the growth levers here, but just to kind of recap that, a lot of it comes down to understanding your role and your responsibility, your decision rights, your ongoing management, right? So from the board through management down to boots on the ground, right? And I think a lot of institutions underestimate, if there's not clarity around all of these roles, how quickly ambiguity turns into risk, right? But moving on to the more exciting pieces about this. So we've been talking internally and all throughout FinTech Shark Week. We know sponsor banking, correspondent banking, this can be a real growth lever for financial institutions and smaller institutions in particular. So what does it look like to turn sponsor banking into a scalable revenue stream without, again, losing control?
Yeah, it's a great question. So, really what we're talking about with respect to kind of what we do at Braid, because it is probably different from what you might see in other kind of of the same type of orientation, software offerings, is that we really focus on payments. So we're focusing on flows and balances. And that means, that can mean interest income and non-interest income. The interest income, of course, would come from deposits flowing into the institution as a result of a fintech. Maybe it's a wallet program or something like this. And then the non-interest income is the fee income generated on transactions. And that can come in any number of meaningful ways. What we did at Portage was, being very conservative. And in fact, the fact that we had purchased the institution and really our first year having lost money, which we knew we would do, was in our business plan. As a bank, that's a very big no-no. And the regulators hauled us to Minneapolis and said, what are you doing? And they had a room of maybe 18 regulators bearing down on the CEO and I. And it was an interesting time in our lives, but it was really quite interesting, because I think that, ultimately what that taught us was, okay, let's be a little more conservative, even if we have a plan. Okay, that's fine. But that we need to grow into this payments type function. And so what that meant is making sure that you have application fees that can justify the startup costs of doing this with respect to personnel and staffing, especially. And then eventually with respect to, of course, BSA engines and other things that you might want to plug in to, to the software to be able to monitor correctly and so on. And then also making sure you have recurring monthly minimums, things like this, so that you are on a recurring basis, continuing to generate the income that you need to sustain the program. Anything above that, anything kind of going beyond that is really kind of where your upside is as an institution, and requires that growth and requires thought as to, how that looks. And so, yeah, we've seen, then I guess getting into different rails, there's kind of different risk appetites for programs, because Braid, at least, and granted, kind of this course is agnostic as to what rail you're going to use. You could use ACH, you could use Wire, you could use Swift, you can use, FedNow, RTP, stable coins. We can move projects down the road for the utilization of any of these rails, card networks, and so on. But it's a question of, what are we familiar with? What are we comfortable with? And then sometimes, we kind of hate to admit it, but what are we presented with? What are the opportunities that come to us that we say, hey, let me look at 3 of these. Okay, I like this one. Let's try this. Starting slow. At Portage, we had a half of a person's day in operations and a half of a person's day in compliance to start. And it was very small. We only had probably 14 people in the institution at the time. Very small, and evolving into a program that had maturity to the degree that after I left the institution, they were able to hire the resumes that they needed to get this thing to go where it should have gone, where it is, destined to go, provided that everything is, run correctly, because it's a constant battle. That's kind of the thing, is it's a constant due diligence thing. Again, don't need to be a genius, do need to do your homework. That's kind of the key. So.
Right. And from our survey from last year, a lot of getting this like board backing, executive buy-in, was really important, obviously, to move forward with any sort of program like this. And that's really where a lot of the hurdle was for a lot of folks. So even if they were to get past that, executives want measurable ROI fast, right? Whether it's deposit, risk posture, operational efficiency, whatever you're doing, they want to see it. So for the first 90 to 100 days, what KPIs would you recommend be tracked beyond kind of go live to prove viability and secure that board support moving forward?
Oh man, yeah, that's a great question. I think it really would depend, because I think there are so many different types of programs. You can have a wallet program, for example, with consumer wallets. We've seen employee benefit type programs where, a portion of payroll goes into a specific wallet for you at an institution that you might not have as much access to, and for the benefit of you in the longer term, you sign up for a savings program. So, that could be one type of program. Or you could see an international wire program where people want access to the dollar, or stable coins, right? Where they want access to the dollar, and what they want to do is keep dollars on the balance sheet of a bank in the US. We've seen a lot of that. We've seen, typical kind of ACH third-party sending or origination type arrangements, or, third-party service providers who kind of act as a facilitator of transactional flows. And so it really does matter. And I actually think that it was useful for us to talk to the FinTech and understand, okay, what exactly are you planning on this thing? And some of the advice we got early on was, whatever the FinTech says, cut it down by 75 to 90%, and then you'll have your ramp, which is partially true. I mean, there's some optimism as to, customer acquisition, I think that happens in this stuff, but it really will depend. And, of course, it's the flashing red lights that you really kind of, when you're starting, are the most important ones to pay attention to. OFAC hits and making sure that you're clearing, and BSA and flags and stuff like this, fraud, of course. And then also, do we have issues with respect to staffing that need to be solved? I think on your first program, you do feel like a baby bird, just awkwardly trying to get out of the nest. And, you might fall to the ground, you might have problems, but those problems are things that you are going to learn from. And, in learning from them, that is what's going to make this a better program. That's kind of the whole point, is that this is a commitment to growth in not just of the institution, but for the people in it. There can be a lot of, this is kind of a tangent, but there can be a lot of, flack. There can be a lot of pushback on middle management when they're saying, hey, what stake do I have in this? I see why the C-suites want it. I see why the board wants it. It's shiny, it's cool. And I can even see why the people on the front line might want to be interested in this because they get to kind of pull the levers. But why should I build this program? And really, what it came down to for me, because I was doing everything at this little bank and really kind of the middle manager, is really like, I'm making myself better. I am growing in a way that is going to create an expertise that is very different from this bank ever having touched before in their legacy. You're creating an entirely new institution within the institution, and that is a really rewarding thing to do. So I'm very proud of what we have built at Portage, and it's interesting to kind of watch more institutions taking this up. So,
no, absolutely. Absolutely. And I'd say if we're getting back to the kind of KPI, it's not necessarily revenue hitting those markers first, but really looking at the risk posture first, making sure that if you're failing quick and you're learning fast, operational efficiencies, and then ensuring you're getting that experience behind those folks on your bench in middle management. Yeah. So one of the things you also had mentioned was finding a fintech, asking them what they want, what their goals are. You got to find a fintech partner that makes sense for you, right? Mm-hmm. And your risk appetite and all of those things, their business lines. So specifically with Braid, and just so everyone knows, this leadership series really is about fintech integration regardless of tech, right? What the program looks like to build it out safely, right? And that's what your playbook's going to be about on this series. But specifically with Braid, there's a lot of control put in the hands of the financial institution, which is really important when managing the risk related to these relationships. So if you're looking for the right fit fintech, some fintechs might say, well, a lot of this governance, you guys are doing is going to slow us down, right? But why could tighter bank control actually help fintech as well?
Yeah. Well, okay. So a couple of things. One is, as you zoom out, you really start to realize how similar all of this stuff looks. And so that's kind of the point of this course as well, is, hey, it might be that these crypto wallet program, the fiat side of a crypto wallet program sounds very different from international wire flows, for deposit balances for the institution. But really, your monitoring of this stuff really does come down to KPIs that look very similar, and the compliance piece, right? BSA, AML, checking boxes, OFAC, making sure you're thinking about travel rule if it's international, things like this. So that's important to know as well, is that, although it feels very diverse, I think you end up doing stuff that really, when you zoom out, does look similar to other, programs as far as management of it goes. As far as your question, I found that paper wall concept that I was talking about is extremely meaningful with respect to what the fintech thinks that the bank knows, and vice versa. And really, that you will find that most fintechs do not have what they should. They will never have the application packet complete that they send you. They will not have one policy that you say, some of one policy that you say, hey, I want to see your, Reg DD policy or whatever, whatever. And the result of that, of course, is that they get to grow with you, and they get to get better. And then in the meantime, they get to impart some of their knowledge as to, hey, how, what does this customer acquisition piece look like? And what does it look like if I kind of step into your shoes for a day and try to understand how your stuff works? And then further, of course, this stuff, since it all starts to look the same when you zoom out as far as kind of monitoring, there's an aspect of it that improves the rest of the institution as well. Because this group is doing things, again, that are intensified over what the regular kind of parts of the vanilla normal operations of the institution are doing. And it can lead to better and tighter controls on the institution. Better reporting is really kind of the main thing to the board and so on. But yeah, I think that ultimately you will find that it might be intimidating to talk to a fintech about something, especially a legacy fintech's been doing it for a while, that comes to your bank and says, I would like to host this here. Let's get married. And then, really you end up both learning from each other in a way that they say, even if they're legacy, they will not have everything that you want from them. They will not. And you will have to do a risk mitigation on that particular item, or you'll have to force them to have it before you launch or within a certain amount of time after you launch. Yeah.
Well, that was a great point that you had made, though. They're going to grow with you. So I think, again, important point, that strong governance doesn't really slow the fintech down. It gives them the confidence and backing, I guess, to build and scale within like clear guardrails with that they wouldn't have otherwise because they're not a big.
Yeah, not only that, sorry to interrupt. It's interesting because these fintechs really want to be exclusive with the bank. They want to, and maybe not exclusive, but at least as close to the bank as possible in a relationship where they know what's going on. It's very similar to back when I was in commercial lending. When you have a great commercial lending customer, they want to interface with the banker consistently. They want to know their banker. This is what community banking is. It's like handshake people that can say, hey, that you can look in the eyes and say, hey, I know you well. We have this trust and we talk all the time and we want to build a relationship. That's what this fintech thing should be, is not some, this is some far off, these are robotic people that run a fintech and they're so much smarter than me on tech. No, this is a relationship and it needs to be kind of acted upon like it is that. And that's kind of why I think community banking is ripe for this, is that having these continual meetings with a fintech and really building it as a relationship that's sticky for the institution, including deposits, is really beneficial to the whole ecosystem.
Right. And I do want to kind of switch gears back to talking about talent. So when you had first started your programs, you had someone half in compliance, someone half in, what was it, BSA or operations. There really is a need for this kind of cross-functional team dynamic, right? Across risk, compliance, treasury, IT, product, until you can build out this larger team and hire the folks you really need to then scale these programs. So what would you say with that important piece in mind, the talent piece, what's different about leading a fintech partnership versus a standard vendor onboarding?
Yeah, great question. I would say there's a couple of things to think about. When you're doing your analysis, I was doing vendor management when I was at Portage, and you're doing this on different layers with respect to how important or crucial or core that this third party represented to the institution. Your core vendor, probably arguably your most important vendor at the institution, needs to be analyzed in a way that, the guy who comes in and changes out the water bottles at the water tower does not need to be, analyzed. And so that same exact thing is going to go on with respect to a fintech. And really what you're looking for with the fintech thing is evidence of good character, right? Of course, evidence of funding that you can make sure that they're, able to survive if their projections are not as if their projections are more optimistic than the reality. Mm-hmm. And then thinking about, as far as kind of reliance or non-reliance on the compliance side, thinking about making sure that they are doing what they should be doing in addition to you doing what you should be doing. What is the kind of hand in glove fit with respect to this partner, roles and duties, and essentially trying to make sure that, hey, all of these normal boxes we would check with respect to third party management have been checked on this, but then also we've thought about liquidity. We've thought about, all these other dimensions that might be affected within our institution as a result of bringing this person on. It does change your risk profile. Of course it does in certain buckets, but the point is that it really can enhance the institution in other ways. And that's kind of the whole name of the game is, okay, how can we do this? And then how can we mitigate the risk that we do find? I think I have probably listed 20 axes of risk that we go through in this course, and that we've gone through at a particular time within an institution. Risk axes that I would never have thought of until I read through some of the, FDIC, FFIEC manuals to understand, okay, how do I need to think about, cross-settlement risk? Like, okay, if they have access to wire and ACH, how do I need to be thinking about that? And really you can get very, not rote, but you can get a better understanding of this stuff to the degree that it feels a lot easier to look at a glance and say, hey, this is not going to work. When I left this firm that I was working for prior to Braid, I knew I was going to Braid, but I got out there in the market to interview with different groups and just to see what is out there. What are these fintechs doing? Kind of try to see, okay, what does the market look like? And I'll tell you that there were ideas that as a banker, when I would walk in for an interview or whatever, and I would talk to these guys for 5 minutes, and I would know immediately, okay, this product's going to fail on like 5 different risk avenues pretty much immediately. And it becomes a lot easier to tell what, do these guys know what they're doing or not after you've done it a couple of times. And it won't take that long because that risk all does look so similar. Again, just intensified and really kind of increased in scope.
Right. And having the right people on your team to be able to identify all of the different various types of risks as it relates to whatever role they're playing in this whole game. It just seems, especially as we lead into kind of the end of this all, where we're going to start talking about the theories of playbook, FinTech partnerships will succeed or fail based on how well leadership aligns people, not just the technology they're pulling in to do it, to be able to identify those relationships that make sense, that they're going to be able to manage the risk commensurate to the relationship, and identify all the areas of risk to adequately mitigate it, right? So people are important. The people currents of innovation, right? So what's next here? Our FinTech integration leadership series that we've been kind of amping up this whole episode launches this spring, and it's cohort based with practical outputs. Each module has policy templates, role charters, decision matrices, and it all rolls into a FinTech collaboration playbook at the end. We are here at NEACH going to cap the year at the Future of Payments Symposium to keep that momentum going strong. That is our capstone event with regard to the future of payments and innovation. So with faster payments adoption accelerating, regulatory scrutiny tightening, and FinTech consolidation underway, institutions that don't professionalize their integration approach in, say, the next 12 to 18 months really do risk being kind of locked out or even priced out of meaningful partnerships. So before we close, Kevin, what's the one thing you tell a financial institution leader about why this FinTech integration series matters and how it can really transform their approach to FinTech partnerships?
Yeah, I mean, I think I would really just stress the fact that we don't know what we don't know. And I found that so much in my career and in my life is, really you cannot be afraid to ask certain questions. And what I've tried to do in writing this course is ask the questions that I wish somebody told me the answer to when I started doing this, so that I didn't have to struggle for months and months to understand, okay, like what even is a FinTech? Like, that was, back then I didn't even know what a FinTech was. It's just I still don't know what a FinTech is, but that's a different story. No, but the point is just that I think we end up kind of afraid to ask the right questions at times based on the fact of what we don't know. And we get afraid of things we don't know. Yeah. And so what we're trying to do is demystify in a way that will really allow an individual or an institution or a department to level up their game and say, you know what, this actually doesn't look as hard as I thought it did when I heard the scary words, that all these monikers and like fake terms that people make up to make these paper walls seem a lot thicker than they are.
Yep.
How can I learn about this stuff so I actually do know what I don't know, and I can actually start to chip away at that knowledge?
Excellent. So for those listening in, if you're evaluating FinTech partnerships or you're ready to modernize your sponsor banking, this series was built for you. If you want to learn more, you can join the spring cohort of the FinTech Integration Leadership Series. We are going to link the program to this podcast, so make sure that you go check the show notes. And if you're listening in as part of a leadership team, we encourage you to attend with at least one or two cross-functional partners, because we know FinTech success is never a solo effort. And if you buy in for the series, you get all access. So that means everybody who needs a seat at the decision strategy table gets a seat at the series and can kind of pick from what is relevant to their job function. All right. Thank you, Kevin, for sharing your insights with us today. I look forward to our continued partnership and the launch of our program. And for those, again, listening in, this has been Payments on Tap, your executive happy hour for payments leadership, serving insights and crafting the future of payments together. So be sure to subscribe, share, and send us your questions so we can put the next hot topic on tap. Cheers.